All right, welcome. If you've ever looked at a business and wondered how they keep track of, well, everything they sell, from the bits and pieces in the back room to the shiny product on the shelf, then you are in exactly the right place. Today, we're going to break down the essentials of inventory accounting for Canadian businesses, from the absolute basics to how it really hits the bottom line. Okay, so let's jump right in. First, we'll cover what inventory actually is. Then we'll figure out how you put a price tag on it. After that, we'll get into the really interesting part, its impact on the financial statements. From there, we'll look at how companies actually track all this stuff, and we'll wrap up with the different methods for valuing whatever's left over at the end of the day. So, Section 1. What exactly is inventory? You can really think of it as the lifeblood of any company that sells a physical product. I mean, it's the core asset they have to work with to bring in any money. Now, the official definition says it's items a business holds to sell or to use to make things they're going to sell. But see that last little phrase, whichever is shorter? That is super important. It's the rule that helps accountants classify inventory as a current asset. And that just means everyone expects it to be turned into cash pretty quickly, which gives investors a much clearer picture of the company's health in the short term. You know, to make this really click, let's just imagine a Canadian maple syrup company. Their raw materials, that's the sap they collect, and the empty glass bottles. When that sap is bubbling away, getting boiled down, that's work in progress. And once it's bottled, slapped with a label, and ready to go, that's a finished good, just sitting there, waiting for a customer. Okay, so we know what it is, but how do we actually put a dollar value on it? As you're about to see, it's not always as straightforward as just looking at the price tag. The big guiding rule here is something called historical cost. And all that means is that you have to account for every single cost it took to get that item ready and in the right location to be sold. It's the true all-in cost. So what does that actually include? Well, yeah, of course you have the price you paid for the item, but you also have to add in the shipping to get it to your warehouse, any import taxes you paid, handling and inspection fees, and if you're a manufacturer, you also include the cost of labor and factory overhead that went into making the thing. All right, so we have our inventory, and we know its cost. Now what? Where do these numbers actually go? This is where we get to see how something sitting in a warehouse has a direct effect on a company's financial health, at least on paper. And this is where it gets really cool, actually. Inventory plays this amazing dual role. For as long as it's just sitting there, it's a current asset on the balance sheet. It's value the company owns. But the second it's sold, boom, its cost flips over and becomes an expense on the income statement. And we call that expense the cost of goods sold, or COGS for short. So how do we calculate that COGS expense? We use this super fundamental formula. And it's really just common sense. You take the inventory you started with, you add everything you bought, and then you just subtract whatever you have left at the very end. What's left over? Well, that must be the cost of the stuff you sold. Let's put some real numbers to that so you can see it in action. Let's say a business started the month with $500 worth of stuff. They went out and bought another $2,000 worth. Then, at the end of the month, they count everything up and see they have $700 left. You do the math, and it tells you their cost of goods sold was $1,800. Simple as that. So here is the most crucial point of this whole section. That ending inventory number is incredibly powerful. Because think about it, the higher your ending inventory is, the lower your cost of goods sold will be. And a lower expense means a higher gross profit reported on the books. It's this direct link that can totally change how profitable a company looks. Okay, so if that ending inventory number is so important for the accountants, it means that number has to be accurate, right? So that takes us right back to the warehouse, surrounded by all that maple syrup. How in the world do businesses actually keep track of it all? I mean, it's a massive challenge. When you've got thousands, sometimes even millions of little items constantly moving in and out, you need a seriously solid system to keep everything straight. And the answer really comes down to two main systems. First, you've got a perpetual system. This is what most businesses use today with barcodes and scanners. It updates your inventory records in real time with every single sale. The upside? It's always current. The downside? It's more complex to manage. The other way is the periodic system. It's much simpler. You just count everything physically at the end of a period. But the trade-off is huge. In between those counts, you're kind of flying blind. All right, this brings us to our final and maybe the most critical piece of this whole puzzle. We know prices for things change over time. They always do. So When that happens, how do we decide what the value of that ending inventory is? The choice a company makes here can have major ripple effects. Method number one is FIFO. It stands for first in, first out, and it's exactly what it sounds like. It assumes that the first bottles of syrup that came into the warehouse are the first ones that get sold. So if prices are rising, this method leaves the newer, more expensive inventory on the books, which gives you a higher ending inventory value and a lower cost of goods sold. Next up is LIFO, or last in, first out. This is the complete opposite. It assumes the most recent items you bought are the first ones you sell. This gives you a lower ending inventory value and a higher COGS. Now, it's a super important concept to understand, but you've got to know that LIFO is generally not allowed in Canada under the main accounting rules, which we call IFRS. And finally, there's the middle of the road approach, weighted average cost. This method basically smooths out all the price bumps. You just take the total cost of everything you had for sale and divide it by the total number of units, and that gives you one average cost that you use for everything, both the items you sold and the ones you still have. And this right here is the ultimate takeaway. Just look at this. Using the exact same sales data, the exact same purchases. The only thing that's different is the accounting method, and it completely changes the company's reported gross profit. Under FIFO, profit looks the highest. Under LIFO, it's the lowest. It's the same business, same everything, just a different accounting choice, leading to a totally different result.